Hey everyone, Ian King here with your weekly market insights video. My co-host Amber is taking some time off this week, so I'm flying solo. And in this webinar, we're going to first talk about what's been moving the markets lately, what's been happening in interest rates, what's the story behind that. And then in Crypto Corner, I've got a great question that I want to answer. But first things first, let me just turn over to my chart so we can all look at the same pictures. And what you're looking at right now is a chart of the yield on the US 10-year note. This is the most important financial instrument in the world because it's the most liquid financial instrument in the world. It is what governments around the world, corporations buy and hold because it is considered the world's safest asset, although I think some of you may disagree. And but that's okay. And what you're looking at is basically the climb in yields that has happened in the last couple of years. So if you look down here in the bottom left corner, this is the beginning of 2022. So January 2022 is when interest rates started at 1.5%. The US 10-year note was at 1.5%. And then we had an absolutely historic climb over the next year and a half up until October of this year. And it was driven in part by inflation, which at one point got to 9% last summer, as measured by the Consumer Price Index. And also, there were a lot of banks that had been sitting on these large treasury positions that were looking at big markdowns, right? There's something like $600 billion in losses because as the yield went up, the value of the treasury bonds that were being held by institutions like banks and foreign governments was going down. And what we saw a couple months ago, Amber and I were talking on a Market Insights video, and we talked about in mid-October after the CPI had been released, we saw a significant decline in auto prices. And what I said at the time was that the Fed's job was working. And basically, the Fed was able to cool the economy off enough that interest rates were going to start coming down, not only on the 10-year note, but also interest rate expectations. So the expectation of what the Fed was going to do next year, right? Right, with the Fed funds rate. And that's really what's been happening. That's been the story. So in mid-October, the US 10-year note was flirting around 5%, and there was concerns that we could go to 5.5%, then 6%, and 7%. And that, of course, would cause mortgages to go up, right? I think they hit 7.5% was the highs at one point. And it would also cause auto loans to go up, and also the cost that businesses borrow would go up. But the exact opposite has happened since then. We've seen a significant drop in interest rates since mid-October, down to below 4%. And this caught a lot of people off guard, right? A lot of people were underinvested in stocks, expecting a big recession, expecting a reacceleration of inflation, and the positioning was all wrong. We even covered that Bank of America had said that the amount of cash that their accounts held in their portfolios was the highest it had been since the COVID crisis. To me, that is a contrarian indicator, right? When everyone is holding cash, it means that they're not in the stock market, which means that we're probably close to a low. And that's exactly what happened. If you look at a chart of the QQQs, which measures the NASDAQ, here's mid-October. Okay, so this is October 18th, and 19th and 20th, Friday, October 20th, we saw a sell-off. Then the next week, we had a little bit of sell-off. We bottomed on October 26th at about 342 on the QQQs. And since then, the market has been just about straight up for the last, let's call it month and a half, almost 2 months now. So we've gone from 344 right near this blue line, which is the 200-day moving average, straight up to new highs, almost a 20% move in the QQQs just in 2 months. We had one of the biggest Novembers ever in the NASDAQ. I think it was the biggest in 18 years. And what I saw on this chart is you had basically a rally in the NASDAQ through most of the year, which is what we talked about with the rise of AI driving big cap tech companies. And then in the summertime, we started to see a consolidation. And as a technical trader, I love this pattern. I love seeing an uptrend and then this sort of descending channel, okay? Because this catches a lot of people off guard. Because people, traders, investors, start to think that a new downtrend is emerging. but you don't confirm that downtrend until you've broken below that 200-day moving average. This curved blue line here. We got close to it, and then we had some good news in the sense that the economy was cooling and the market was just off to the races. And we've been calling for a year-end rally now since the summertime, and it really started in mid-October, and it still looks like we have some more upside into the year end. And the reason why I say that is because what happens is that hedge funds that have these positions on their books that they've been up a lot in, they will start to kind of juice them into year end so that they can show that their percent returns are higher. And it's called painting the tape. And they try to mark their positions up as high as possible into a very low liquid environment into year end when there are not that many people trading. Now, this bottom indicator right here is called the relative strength index. And I just want to note one thing is that what we're also seeing in the RSI is when you get above 70, which is where we are right now, we're at 75. This tends to mean that the market is overbought. And when you get below 30, it means we're oversold. We hit a couple overbought readings this year, most notably here in June, where the market had a short-term peak, I would say. And then we had another one in July, which was more of a medium-term peak because we didn't take out that peak until mid-November, right? So from July to November, you're looking at 4 months of sideways action. And we're also seeing that move up as well. The key is whether or not RSI is diverging, which means that when the market is going to a new high, you want to see the RSI confirm that. So you had an RSI above 70 in November 20th, and now you're seeing the market move up and the RSI is moving up. I would be more concerned if with this latest move in the market, the RSI was not as high as it was. So you don't want to see that RSI divergence. That's negative. This is actually a positive technical indicator. However, the market feels overbought. So from a trading perspective, I probably wouldn't be adding on too many positions right here, but I would let the ones that I have on run and potentially look for some sales into a very low liquid environment into year end. One other chart that I want to show is the ARK Innovation ETF. For me, this is a barometer of mid and low cap growth stocks because it has significantly underperformed the market over the last couple of years. The reason is because low cap or growth stocks have a tough time outperforming the market when interest rates are going up because these companies typically are not making money, so they're going to have to raise more cash, and they have to raise more cash in a higher interest rate environment. It hurts their future earnings. But what we're seeing now, because rates are going down, ARK ETF is actually outperforming all the major indexes. So you're seeing a bigger rally in the ARK ETF than you are in the S&P 500, in the NASDAQ, and of course the Dow, which is also a new 50-week high. And I do think this is going to play catch up. One good news on this from a technical perspective is that this hit a medium-term peak in July when the NASDAQ also hit that, and we've actually cleared that level now. Okay, so from a technical perspective, we might play, a little a retest here and there. But I do think that this move on strong volume means that there's going to be a big move in medium and small cap growth into year end and potentially spill over into next year. The other major standout in crypto, I know we talk about crypto coin every week, and we've talked about Solana. Solana has outperformed every major cryptocurrency significantly over the last couple months. The reason for it, and something also we discussed in September, is that Solana has this similar digital infrastructure as Ethereum, where it is a cryptocurrency that you can build new digital things on it. But it also uses a consensus mechanism that makes it a lot faster and cheaper to use. So a lot of companies that are trying to build something that's based on a blockchain are switching to Solana because it's, like I said, it's ready for prime time right now, and that's why we've seen a significant rise. Now, from a trading perspective, this move looks really extended. It's not something that I would be buying into, but I think that Solana is probably something in your crypto portfolio that you would want to buy on pullbacks. It's also a token that we recommended 3 years ago now at $1.50, way back before it was on anybody's radar. And since then, it went to $260, then came all the way back and gave you another buying opportunity this year as well before it moved higher. Let's take a look at the mailbag. I've got a great question this week from Jesus, and he writes in, "Hello, Ian. I keep reading that one of the more prominent narratives for the coming bull run will be in crypto gaming gambling. Do you agree?" Thank you. Okay, so yes, I do agree. I think the big narrative in crypto is going to be two things: decentralized finance, which allows you to take something of digital value and apply the rules of traditional finance to it without needing a middleman. And I think there's going to be a big move into tokenizing real world assets. We've already seen a proof of concept in this happen with JP Morgan and Apollo Group, which is a large alternative asset manager. And I also think the other thing is going to be decentralized physical infrastructure. So being able to buy some type of device that provides a digital resource, where that could be cloud storage, computing power, it could even be decentralized GPS mapping, and you would be compensated with that with a token. And a lot of this decentralized physical infrastructure is actually getting built on Solana. Okay, so some of the major projects like Hive Mapper and Demo and Helium are built on Solana, not Ethereum, which is one of the other reasons why this token has risen so much. Now, when it comes to decentralized gaming, well, what does that mean? First of all, gaming basically, many of us who have children and grandchildren that like to play games all the time, it's a very closed ecosystem in the sense that if a child is playing Fortnite or let's say Roblox, the amount of time and attention they invest, and this is an investment of your time, attention, and oftentimes money, goes into building an avatar or a character that is still owned by the platform. Okay, so if you are playing, let's say, Fortnite, and you build out your avatar, if you leave the platform, you can't take that avatar with you. Now, what blockchain gaming will do will give you ownership of that digital asset. And so they're building games, and you'll be able to transact that asset. Like Axie Infinity was the first big blockchain game that came about, where people were building these, cartoonish like characters, and then they would be able to go and resell them on other marketplaces. Or, Axie Infinity went and they built out other games that you could play with your avatar. Now, look, I know some of you might think this is crazy, and I don't game, but that doesn't mean that other people don't. In fact, the gaming industry is $100 billion a year business, and we're talking about allowing players to keep the digital creations that they make. Now, if you apply that to, let's say, social media, so think about how Facebook works. When you have a Facebook account or an Instagram account, you're essentially turning over your data to these platforms, and they can use your data as they wish, right? They can market you things given your likes on Facebook, or they look at your photos, and if you're taking photos at the beach all the time, you might see an ad for a new beach chair or a beach towel, and the data is not yours. But imagine new platforms that come out in the future where your data is yours, and if you don't like Facebook anymore, you can take all your photos and videos or anything you uploaded to the site and migrate it to another social network, and that is going to create more competition for Facebook and other social media platforms because of what blockchain is doing. Now, you also asked about gambling. There are a number of crypto gambling sites that basically allow you to take a smart contract and wager on the outcome of a specific event, and that could be, betting on tonight's football or basketball game, and then the smart contract automatically settles that bet and pays out whoever the winners are on that smart contract. And this is all done, without needing a middleman. You just essentially need a smart contract to run that. So I don't think that gambling is going to be as big as a narrative as decentralized finance, decentralized physical infrastructure, and also gaming is. But thank you for pointing that out, Jesus. And that is it for this week's Market Insights. I want to thank everyone for tuning in. Any questions, marketinsights@banyanhill.com. Have a great week, everyone. Talk to you next week. Thank you.